Welcome to the 2013 webinar series for dentists, orthodontists, and other dental specialists. This webinar series is brought to you by Procore CPA, the #1 choice for dental professionals. Today we have two special guests on with us. First, let me introduce you to Rob Bay. Rob is a partner at Procore CPA and works with dentists all over the country. With his background in business and human development, he brings a light to the dental field. In addition to Rob, we also have Gary Takis, who has been helping dentists develop their ideal practice all over the country, specializing in the business of dentistry. His unique, in-depth knowledge of the components of a successful practice has helped all these offices throughout the country. Although Gary is not a dentist, he does own his own practice in partnership with Dr. Paul Nielsen. His practice is called Lifetime Smiles Dental Care, and his practice serves as a learning and teaching laboratory for Gary to test concepts that he can apply in his teachings. So with no further ado, please take out your pens and paper, and if you have additional questions, we will answer those at the end of this webinar. But first, I want to hand it off to Gary. Gary, can you get us going here today?
Well, hey, Curtis, thanks so much for that wonderful introduction. And let me welcome our guest to the webinar. We have a fantastic audience, Rob, from all over the country. I can see them in the panel here on my screen. We have guests from all over the country. And it's very exciting. I am so excited about tonight's course. And let me kind of frame tonight's course before I turn it over to Rob. What I'm excited about today's course is that if you are following the kind of advice that I've been delivering for our clients, you're becoming more and more successful. You're learning how to develop a thriving practice. And of course, one of the byproducts of that is greater income. And doctors, you deserve to be very well compensated. What you do is hard work, and you deserve to be well compensated for that. And so the byproduct of a thriving practice is to have more income. However, one of the things I've noticed over the years, as doctors start to increase their income, if they don't plan for that, and if they don't have proper guidance and proper counsel, very often the byproduct of increasing income can be that they have a significant tax bill that can be a surprise. So the reason why we wanted to put together tonight's seminar is to provide you with information that will help you reduce your tax liability using proven conservative strategies and techniques so that you can keep more of that hard-earned money that you've worked so hard to earn. So Rob, with that kind of framework for tonight's webinar, can I turn it back over to you and dive into tonight's course?
Sounds great. Thanks, Gary. Hey, I really appreciate your understanding of the importance of being proactive in this regard. So many times dentists get into a comfortable situation, and in doing that, they end up paying far more in tax than they're really needing to. So thank you for that. I wanted to just give just a little bit of history on Procore. Procore is obviously a CPA firm. Although I myself, being a partner of the company, am not a CPA. Our firm is very proactive with regards to tax strategy, and then also utilizing your accounting and practice information to be able to help put the dentist in the best possible financial position. We see so many dentists that pay far more in tax than they need to, as well as are not optimizing the potential within their practice. So we help them implement strategies and make more money, make good decisions with their financial information, and then from the tax perspective, minimize the amount of tax that they're paying and keeping that money that they've worked so hard to earn. So I want to paint for you initially here a picture of a typical situation that we see all the time. We work with dentists all throughout the country, everywhere where dentists are subject to U.S. tax, and this is a very typical situation that we come across. The typical dentist that we see has somewhere in the neighborhood of $700,000 to $800,000 in collections. That $700,000 to $800,000 in collections is producing for them somewhere between $200,000 and $250,000 in what I'm calling here is income, but really what I mean is profits to the business. You may find yourself in this situation, but say, okay, my business has $200,000 to $250,000 in profits, but it doesn't really feel like $200,000 to $250,000 in income. Some of that are things that we'll be talking about here today in this webinar. This typical dentist is paying somewhere between $60,000 to $80,000 a year in tax, and I'm including here federal tax, state tax where applicable, and then also self-employment tax. And what we find is with these dentists that they're overpaying $23,000, and this typical dentist on average is overpaying $23,000 in tax every single year. Now, in addition to overpaying in tax right now, the government is targeting high wage earners, and they classify that as anybody over $125,000 who is single, or if you're married and file joint, somebody who earns over $250,000. You're being targeted for additional tax increases. Now, there already were some things that were intended to go into place this year for 2013 that were stayed for a period of time, and there were things that were implemented. The maximum tax bracket, for example, was increased from 35% to 39.6%, an increase of almost 5%. In addition to that, there's a Medicare surplus tax, which is an additional 0.9% tax that was added this year. Also, for those of you who are set up where you're taking some of your income as dividends or distributions rather than as wage, there's another surtax that was being added and assessed, which is almost another 4% in tax. So those who earn more money, which typically dentists fall within this category, are being targeted to pay more and more and more tax. Now, and this is, I don't really foresee this trend changing in the near future. The current system that we have in place with government is really trending in that direction of increasing tax on those that are higher wage earners or higher income earners, which you as a dentist find yourself in that situation. A lot of times I like, yeah.
Rob, one comment I wanted to make while you have that, in kind of identifying that typical situation that you often see. And Rob, I think you agree with this, but I'd like you to comment as well. If I can share this with our audience, I've had the privilege of traveling extensively domestically, of course, but also internationally. And Rob, I happen to believe that we live in the greatest country in the world. I'm a little bit biased about that because I love our country, but I happen to think that we live in the greatest country in the world. My grandparents were Hungarian immigrants. They immigrated in the 1920s. They literally came to the United States from Hungary with the clothes on their back and whatever they could fit in a suitcase. And I count myself very grateful for them making that decision to come to the United States. However, with that said, I happen to believe we live in a great country, and I don't have any problem paying my fair share of taxes. However, I'd like not to have to pay any more than is required. Rob, would you agree with that? I mean, it seems like an obvious statement, but would you agree with that?
Absolutely. I definitely would agree with you that we live in the greatest country that there is. So much opportunity, such a great place to live, but also agree with what you said about wanting to pay or willing to pay our fair share. And really what we find, Gary, is so many dentists are paying just far more than what they need to. Their fair share, really, if it was calculated properly, on average is $23,000 less than what they're paying, and they're paying a lot more than what they really are legally required to pay.
Well, let's put that in context too. Take that that $23,000 annual example that you have up on the slide. Let's put that in context for our audience. And the context I like to put that in is, sadly, the American Dental Association reports that in 2012, this is the most recent year, of course, we have information, that only 3% of dentists in the United States could retire at age 65 and not reduce their lifestyle. Rob, that's a hard statistic from the American Dental Association. Let me repeat it, only 3% of the dentists in the United States can retire at age 65 and not reduce their lifestyle. But now imagine if our, our hypothetical dentist here could take that $23,000 in tax savings and apply that toward some kind of a retirement or savings plan, do you agree that we could radically change what their retirement might look like through the shifting of the tax burden to some kind of a savings plan for them personally to retire? That would make all the difference in the world.
Absolutely, and actually that's something that we'll be getting right to. I love talking about the impact of these things. $23,000 is a lot in and of itself, but really when we're talking about over the career of a dentist, the impact is enormous. And implementing proactive strategies in tax, as well as doing things to be able to have their practice be something that's enjoyable and more profitable, will make a tremendous difference, not only on a one-year basis, but overall as they're looking at their entire career. So one thing I really like to ask, and a lot of times in doing webinars or in groups of people, I like to ask this as a poll question and get feedback. And we're not really set up to be able to get feedback here today, so I'm interested, Gary, in some of the things that you find. But I like asking dentists, how do you feel about the amount of tax that you pay? And based on your interactions and what you're finding and you're seeing, what are you finding, Gary?
Oh, this really jumps out at me, and I myself personally, prior to getting good guidance from this, door number 2 was the answer that I would answer personally. That definitely feel like I'm overpaying. The other one that comes to mind would be door number 5. That I really don't know, because I don't know what is allowed, and it's not my field of expertise, and so I'm counting on advisors to be able to tell me, what is possible. And so the 2 that jump out at me is I definitely feel like I'm overpaying, and perhaps I don't know.
Well, you hit the nail on the head. Number 2, I definitely feel like I'm overpaying, is by far and away the most popular answer. And maybe it's a little bit of self-selection. People who are attending this type of event are concerned about the amount of tax that they pay. But people feel like they're overpaying in tax. And the second one definitely is I don't know. Those 2 are definitely completely far above away the majority of the responses. A lot of people think that they're overpaying, but they don't really know. They don't want to do anything questionable. And don't really realize that there's a lot of things that can be done that are completely in the light to be able to minimize their tax.
I know where I want to be is door number 3, and that's where we'd like our clients to be, is feeling like they're paying their fair share, but no more than is necessary.
Absolutely. I really like a combination of door number 3 and door number 4. I pay my fair share, and I know for certain I'm paying the least amount possible.
There you go. You bet.
That's the optimum, and that's really what we're wanting to get to. Now, you started to talk a little bit, Gary, about the impact of how this affects a dentist, and when we run the numbers of how this affects a dentist over their career, just this overpayment in tax or not being proactive as it relates to tax, there's 2 main things that we see as we run the numbers. That first, there's over $1 million that is lost in opportunity and in actual payments that are paid out in excess tax. $23,000 is a lot of money, but $1 million is a lot of money. Over a career, that really can make a huge difference to somebody. Secondly, by being proactive in their practice and having a practice that that's optimized and then more profitable, as well as minimizing the amount of taxes they pay, will actually allow them to be able to retire 10 years earlier. Not necessarily that they are, but dentists love that feeling of knowing I can retire, I'm set, I'm able, I'm continuing to work out of choice because I'm wanting to, but at any point when I decided to do something different, I'm able to do that and could make that decision and retire. So
wow, what a difference! What a wonderful situation to be in, to be able to work because they want to, not because they have to.
Absolutely, that feeling is completely liberating, and we find a lot of clients that are in that situation. Gary, you probably find a good number of your clients as well that are in that situation where they've done things to be able to get themselves set up within their practice. It's successful. They're keeping as much of that money as possible, and they'd be able to retire, but continue to do the work because they enjoy it and they want something to do, and this is what they love.
Right.
So as we move along, I want to talk about why this happens, and what really is causing this. Typically, in a relationship with a dentist and their CPA, well, I shouldn't say typically, but there really are only 3 methods of reducing tax. And these are the things that your CPA is likely pursuing or likely looking at. Number 1 is your allowable deductions. And these are things that you're spending within your business that are going to be able to minimize tax. You're buying equipment, you're buying vehicles, whatever those expenditures may be. Second, and this is one that we see a lot of dentists that will implement this strategy, and a lot of times this strategy is pursued because there wasn't really a whole lot of proactive tax strategy happening throughout the year, and that's having deductible investments. At the end of the year, you go and you meet with your CPA, and you say, oh man, I really don't like how much tax I'm paying. What can I do? Let's put money into a 401k or into this IRA, and in doing that, we will be able to reduce tax. And so that's the second way. And the third one are available tax credits. And a lot of times CPAs aren't really maximizing or taking advantage of these. And there's some examples that a lot of our dentists are utilizing are solar credits, manufacturing credits if you have a CEREC machine. There's a lot of available credits out there, and so that's the third way of going about it. And typically in this situation, the dentist will gather his information. The year is over. Take it to my CPA. Here you go. Here's all the information, almost like a drive-through window. Pull up to the next window. Here's your tax return, exactly what you ordered. And now that's a little bit different than what I would consider to be a proactive tax reduction strategy or plan. A proactive strategy is something it's a 12-month-a-year strategy. It takes each of those sections and then expands upon them. We're going to be reducing tax in each of these ways, but implement things all along the way, evaluating where you're at, what's going on, what's changing in your practice and financially, what's going on with the tax code and laws. I mean, those are ever changing. And then what are the things that we can implement to be able to minimize the amount of tax that is being paid. Now, these are things that should be looked at with careful consideration to see if there's things that apply. But these may also be things that you've heard of in the past and things that you've possibly even taken to your CPA and said, hey, I've heard some people are doing these things, and you may get feedback of, oh yeah, we can implement that, or no, we shouldn't go about that. That's not enough return for the amount of trouble that it is. But I want to talk. I'll get more into some of these specific strategies. But these are things like how your business is structured, paying your children. Should you plan to defer income? Captive insurance companies, family foundations, corporate resolutions. All of these things are things that can be done proactively and completely, legitimately, legally, above board, morally, to be able to minimize the amount of tax that is being paid.
Rob, I love this slide because of the way it demonstrates what I see as a fundamental concern that I've identified with many dentists over the years. And Rob, what I've noticed is that, and I'm not trying to be critical of dentist's current counsel or their current CPA. But what I noticed is that many dentists, the role that they have with the CPA is the CPA functions as an historian. In other words, they tell the dentist what happened, and then they report to them, what resulted in the tax consequence of what happened. As opposed to this approach, which is being proactive, which is to develop strategies to implement ahead of time to get a better end result, as opposed to just reporting what happened. I see that as a fundamental difference in the quality of advice that many dentists receive. Do you notice that, Rob?
Yeah, absolutely. I mean, the typical situation, as you described, is that historian. CPA, here's all my stuff. Tell me what happened. Tell me what I need to pay. Now, a CPA's value is not in just compliance or in filing of the return. The real value of what the CPA can provide you is giving you help, is giving you strategy, it's helping you to plan and know what to do rather than just telling you what happened. A proactive strategy is something where your CPA should be seeking you out and meeting with you at least on a quarterly basis to see where you're at, what's going on, projecting out what that means, and then what can be done.
Hey, Rob,
yeah.
As you're saying this, an analogy came to mind. And the analogy, since we have a dental audience tonight, the analogy that came to mind is imagine as a dentist, imagine the experience of only treating a patient once they had a problem. I have a toothache, and then they come to the dentist and you fix it. Versus a proactive approach where you work with that patient to educate them, to provide good home care instructions, and to provide them with the proper information they need to maintain a great oral health throughout their life. So it's a difference between being proactive versus being reactive, and I think our listeners can appreciate the value of being proactive when it comes to patients' health. Well, what about being proactive when it comes to your own financial health?
Absolutely. Now, one thing that's important to realize here is a CPA is very hard to rehabilitate. The business model for CPAs is volume of tax returns. That's how they make their money. And so they want to process as many returns as possible. And for a dentist to think that I can now be proactive with my CPA, that the results in doing that I found are very short-lived. That you will go to your CPA, you'll find a few things, you'll implement those, but that type of interaction is not sustainable. If their business model is not such where they're being proactive with you now, it's very unlikely that relationship is going to change. Now, one thing also that I hear from dentists is a concern that I want to make sure that I'm not doing anything that's going to cause me any problem. And sometimes I hear about red flags or things that could cause me issues or problems. And so I want to talk about the difference between white strategies, gray strategies, and black strategies. All the things that we're talking about, everything that I'm bringing up to you are all things that are completely white. And by white, I mean they're legal, legitimate, they've stood the test of time, there's case law, there is a precedent that these things are legitimate in the dental community, and they hold up. The gray strategies are things that sometimes we have clients that are a little bit more aggressive, and they will want to implement things that are maybe a little bit beyond what would be the norm. An example may be that they're going to buy a vehicle and expense the vehicle entirely within the corporation, although they may use it also for personal use. The majority of the use is not business use. And in those situations, we want to make sure that the dentist knows how this would affect them, what the likelihood is that this may be be looked at, and if it's looked at, what's the likelihood that that would be overturned, and then what the impact would be if they chose to make that decision. Because it's really the dentist. The dentist is the only one whose signature on the tax return carries any weight. They're the one who ultimately is liable and responsible for whatever it is that happens on that return. So the things that we bring to our clients are all things that are completely white. If we have clients that are more aggressive, I don't know of a better word to use other than aggressive, we help them to make sure that they know the impact of those things, and then they can make those decisions. Now the black things are things that will end up causing somebody, what we call black, or things that will end up causing somebody to get real problems. And what I mean by that is go to jail or have major issues. We'll never ever let anybody put anything in place or do anything that would ever cause anybody to have any of these types of issues. The things that we're bringing forward and the things that I'm talking about are things that are completely white. And we find dentists that are in all spectrums from white to gray. And we try to put together the right solution that's best for them, bringing forward to them the things that are white, and then helping them to understand the impact of things that they may have heard of or that they're wanting to do that may be in a little bit of that gray area, and understanding how that may affect them. So when we're talking about proactive tax planning or proactive tax strategy, there's a few things that I'm going to bring forward that may apply to you or may not apply to you. These are things that you'll want to have looked at and know if it's something that makes sense for you. But I want to bring about some ideas to get the juices flowing and show each of you that these things really are possible, that there are things that can be done. Because there are people that are in that category that they just don't know. They don't know what's out there. Or they're in the category of, I feel like I'm paying too much, but I don't know what to do about it. And so I want to show you some specific strategies, and then talking with your professional, or if you don't have somebody that you feel can help you with that, we'd love to talk with you more specifically about these in your particular situation. You'll be able to know if these are things that apply to you. So first off, I want to talk about the way that your business is set up and the way your practice is structured. You may be a sole proprietor or an S corporation or a PC, which is really another type of S corporation. You may be an LLC, a PLLC, a C corporation. There's a myriad of ways that your business could be set up. And sometimes a dentist may not realize that the way that that's set up is affecting them. So I ran a little situation or a scenario. And no matter how you're set up, there's really only 4 ways for your taxes to be filed. One is you're a Schedule C, which means that you're a sole proprietor. The business, it really falls under your Social Security number. You could file as a partnership, where most of the time that comes forward if you're an LLC or PLLC. You can file an 1120 return for a corporation, which strictly is a C corporation, or 1120S, which could be an S corporation. It could be a PC, or it could even be an LLC, where you've filed an S election to be taxed as an S corporation. Now, in this scenario, I ran a practice that has $700,000 in collections with 50% profitability, so $350,000 in income. And I ran this without having any type of other type of personal deductions. And this is what happened. This is based upon where I'm located in the state of Utah, with the amount of tax that we're talking about. Now you can see here in this scenario that we're looking at about a $48,000 variance between the high and the low. Now your eyes are probably gravitating there to that 1120S S corporation, and I'm not saying that your business should be set up as an S corporation, or you should be a PC, or you should file an S election to be taxed that way. What I am saying is that you want to be deliberate in what you're doing. There very well may be a good reason to be set up in another way. As an example, if you're in the state of Tennessee, there's an excise tax on corporations if you're a professional corporation, which would cause you additional tax. And so because of that, you very well may be better served filing as a sole proprietor or having your business structured as a sole proprietor. In other situations, you're better off being set up as a partnership, being an LLC, and being set up with a husband-wife partnership. And really, my main point here is you want to be deliberate about how you're set up and why. If you don't know why you're set up the way that you are, other than this was just the advice from my CPA, then this is something that you need to have looked at to know specifically, why am I set up this way? What are the advantages? What are the disadvantages? And taxes is one of those things, but it's not the only reason about why you'd be set up a certain way. Now, as we're doing this, it's important to understand the way that the money ultimately ends up getting to you as a dentist, so that you can see how that money flows and then how ultimately it affects you in tax. So if we look at here within this top section, as we look at the business, and then the bottom section we're looking at you personally. You have your total collections, which I'm calling here gross receipts, and then from that we take away all of your overhead, your business expenses. And ultimately that leaves some profits for you. Our objective in working with practices is that the proprietor, the dentist, would take home 45% or greater of the collections of the practice, and that ultimately would be profits to you as the dentist or the proprietor. Now, those profits end up coming to you in two different ways. One, as wage, and that would be if you're a sole proprietor, all of that's coming to you as wage. If you're set up as an LLC, it's also coming all to you as wage. If you're set up as a C corporation or S corporation, that portion that's coming to you as wage is what comes to you as a W-2. That may be your salary or a draw. There's a lot of different names of how that gets to you, but really it's what ends up on your W-2 at the end of the year. That wage is the most expensive way for you, tax-wise, for you to be able to receive your money. You're subject to federal tax, state tax where it's applicable, and then also full self-employment tax. Now, if you can shift some of that income over towards the right, which is dividends or distributions, and I'll explain really what the difference is between these two, it's a little bit cheaper way of getting your money. Still subject to federal tax, still subject to state tax where applicable, but is not subject to self-employment tax. Now, the difference between these two, the wage is set up in a way where it's coming to you for the personal services that you're providing as a dentist, your actual dentistry. The dividends, or the right side of things, the dividends or distributions are coming to you in a more passive manner for your role in being the owner or the proprietor of this practice. And so we want to be deliberate in where that money is going and how much of it is considered wage, and then how much of it is coming to you in dividends. If we can move some of your money towards the right side, that's a way to be able to help save you in tax. Now, additionally, there's one other way that money can come to you or be directed to you. And if you look at this, it may not be obvious, but if we look in that section there of business expenses, or what would be considered overhead to your practice, that's another way that money can come to you as the owner of the practice before it ever comes to profits and before it's actually ever even subject to tax. And in doing this, we may move it to some other type of system that's taxed at a lower rate, or find ways of getting that money directly to you. Our objective is to take those gross receipts and get as much of that collection to you as possible with the least amount of burden, tax-wise or overhead. And so if in these situations, as we're talking about business expenses, the IRS uses some nomenclature. These expenses, in order for them to be legitimate, need to be what they call ordinary and necessary. And ordinary, the way that it's defined, is these expenses that are common or acceptable within the industry of dentistry. This is something that's happening on a regular basis. It's pervasive. It's not an isolated incident. And then also things that are necessary. This is something that actually helps in the building of your practice or in the benefit of you conducting business. Those are two key components. A lot of the best strategies that we can implement are in this category. We can look at your business structure and help move income, again, from being wage over to being dividends or distributions. But some of the best things that we can do is move some of this money where it's coming to you in other ways that are considered expenses to the business or considered overhead to the business and are not subject to tax within that its own component or within that business itself. And so we'll talk about some of these specific strategies that help or allow to facilitate this. The first one that we will usually look at is the benefit in owning your own building. Now, in owning your own building, your business or your operating company or your practice, we set it up where it's paying rent over to another entity or over to you for owning that building. The depreciation benefit that you will get on that building will, in almost every instance, far outweigh the actual cash outlay that you put in investment into that building. You're able to deduct the interest. It also will provide you, even though in reality you're getting positive cash flow, we're able to create paper losses by means of that depreciation. When you purchase the building, also it allows for some extra benefits up front in the way that you depreciate it. A building will be depreciated in a few different ways, but most of the time a building is depreciated on what's called a straight line. But it's over 39.5 years that building is depreciated, and you're able to take those tax benefits spread out really over 40 years. Now there's some ways and means that we can accelerate that. Some of the things within your building don't have a useful life of 40 years. Or if you were to resell them, they don't have the same value. If you were to take the flooring in your practice and pull it up and try to resell it, it doesn't have the same value. Or some of the light fixtures or ceiling tiles. And so what's done is it's called a cost segregation, where a study is done. It's determined how much of your building falls into which bucket, and some of those buckets of things are able to be depreciated on a quicker basis. And if you find yourself in a situation where you're needing some tax benefits now, this is a great strategy. And as I was saying before, you have actual positive cash flow, but it creates paper losses within your practice. And then ultimately, with the building, you're able to put together and set up an installment sale at the time of selling your building, where this is applicable, to be able to defer tax over a period of time instead of taking all that income at one time in particular. This is one strategy that can be implemented and put in place, and it's something, there's multiple benefits that can come from it. But in most situations, there's a good benefit tax-wise in owning your own building. Not only tax-wise, but also investment-wise. Another strategy that we look at, we call this strategy corporate rent, but what it really is it's a use of your home for business purposes. Now, this is really different than what you may be thinking. We're not talking about we're going to segment out this portion over here on the left where you see that bay window, and this is your office, and it's 20% of the building and or 20% of your home, and so then you're paying rent to yourself, but you're having to capture that rent as income and then offset it with expenses. That's not what we're talking about. That's a strategy that in most cases the amount of work that has to go into facilitating that really isn't worth the benefit. There is not a huge benefit in doing that tax-wise. What I'm talking about here, as we go back and we say, how is your business set up and structured? If you're set up as a formal business, whether it's an LLC or a PC or corporation, however it is, you're required at least annually to have a formal meeting with the officers or members of your business. You have minutes that are taken at that meeting, and so, but you're likely having a lot of interactions and discussions about business with your spouse, or a lot of times it's with the spouse, and a lot of those things happen at home. And so we want to be able to take that, something that you're already doing, make it a little more formalized, and provide a tax benefit. And so what we recommend, and again, this is something that you need to have looked at for your particular situation, is that your business has more formal meetings with its officers or members. That it finds a place or a facility to rent to be able to hold that meeting for the day. The place that we recommend that you rent is your home. Now, the IRS will allow you to rent out your home. The way they word it is less than 15 days a year, so it's 14 or less days a year, and do that in a way where it is not taxable income. It's not reported on your tax return, and there you pay zero tax on this. Now, Gary, when you and I were talking about this strategy before, you told me a little bit about the way that that you had went about determining how much it was that you had paid to be able to rent your home.
Yeah, let me share that, Rob. It's a strategy I'm very excited about, and I have found this a very useful way to reduce tax liability. What we did was, we're in Phoenix, Arizona. We identified a commercial business that rents business space where we could hold meetings. And the place that we chose here in Phoenix happens to be called the Wrigley Club. It was named after the original Wrigley chewing gum family. And it's a business club where you can rent space. They have meeting rooms of various sizes where you can rent small conference rooms, medium-sized conference rooms, larger meeting rooms, and so on. And we received a written bid from them in terms of what we would pay if we were to hold our meetings there. And it amounted to around $1,200 a day was what the bid was. And we used that to benchmark the value of renting our home for those same spaces. Rob, is that a useful way to benchmark the value, a fair market value of similar space, and being able to use that as justification for the amount that we choose to deduct in this particular expense?
Yeah, absolutely. That's the best way of doing it. We regularly will do those studies, and we'll find what's available within the area. And we typically will find things that are in the neighborhood of $700 to sometimes a couple $1,000s a day to be able to rent that type of facility. The average that we see is somewhere around the ballpark of $800 to $1,000 a day. And if you rented out your home for $1,000 to be able to hold that meeting, and you did that 14 times a year, there's $14,000 that's going to you from your practice tax-free. Now, in most situations, this is going to save you somewhere between $5,000, $6,000, sometimes $7,000 in tax. So this is a situation where we're able to take something that you're doing already, provide a tax benefit. It's being pushed up into that category of business expense to your business. Now, there's some things that need to be done to ensure that this is legitimate. You need to actually have the meeting. You need to know what's available in your area and have some type of documentation of what that is. you need to have some minutes for this meeting, and yet you need to write out the check from your business to you or to your spouse for that meeting. And in doing that, this is something that's been looked at or reviewed out there in in the United States hundreds of times. And in those situations where those things are had, this is a strategy that holds. It's a white strategy. It's a great strategy that can be implemented to get money from your business to you with the least amount of tax implication. Another strategy that we like to look at that falls into this same category is paying your children. Now, in paying your children, you don't want to pay your children directly from your practice. If you do, and you have employees within your practice, which most practices do, then they're subject to a lot of the same rules, and tax will be withheld, including your portion of the FICA tax, their portion of the FICA tax, federal and state tax, although they may get some of that federal and state tax back. But what we recommend is you set up a separate mechanism, even if that's a business entity that's a sole proprietorship that's owned by your spouse, and you're paying that entity, and then that entity or that business is then paying your children. And you can pay your children almost $6,000 without having them have any type of tax implication. Now, if you're somebody like me, I have 6 children. That means I'm getting close to $35,000, $36,000 that I can pay my children, and then they can use that money for the types of things that they're doing already anyways. I've got kids that are involved in soccer, and they're involved in dance, and I've got some private school, and all those things cost money. They're buying supplies, they're buying clothing for school, all of those things. And so then as I pay them and then they're able to pay their own expenses, I'm now able to do that with pre-tax money or tax-free money. The things that you're paying them for need to be legitimate expenses or legitimate of things that they're doing that are in benefit to the practice. That may be some shredding, it may be some cleaning, it may be some filing. Also, as you can see on this slide here, this is depicting a dentist with his family. These children here are involved in doing some modeling for the practice, and that may be used in some of the marketing materials or their website or pictures that are hung up within the practice. But this is something that you want to look at and have evaluated with your particular situation, again, to see how best to put this together and what is the appropriate amount, because not in every instance will you be able to maximize that dollar amount for your children, depending upon some of the things that they're doing or the things that the services that are being provided to the practice.
I especially like that strategy of using the children as models because of the fact that you can justify a larger compensation for them up to that amount that you suggested, below $6,000, so it's not subject to filing a return. Because if we were to hire others to serve that function, the fees would likely be in that range. So I find that to be a useful strategy, Rob, because of the fact that it allows you to get up to that almost $6,000 level without really smoke and mirrors, because normally the hourly rate for stuffing statements or doing shredding, that sort of thing, would be fairly low, and you'd have to justify a large amount of hours to get to that point, whereas modeling fees could be easily justified to get to that $6,000 point.
Absolutely. Yeah, great strategy. Great thing to look at or consider doing. And again, this is another strategy where that money goes from your collections. This is now being taken out as a business expense. It's not flowing to you as wage or dividend, but that money is coming to your family by means of a business expense, not taxable to you or to your children. Another strategy of this type that we look at, And this is the strategy that we look at particularly in situations or instances where a dentist has a good amount of excess cash. They're making a lot more money than what they're needing or they're using within their home, and then they're taking that money typically and then finding things to invest in. And in those situations, we look at captive insurance companies. What a captive insurance company is it's a real insurance company. It's licensed with the state, but it's an insurance company that you own. It's called captive because the only entities that it insures are yours. So it will insure your company. It will insure you. It insures actual risk. It goes through underwriting by a real underwriter who puts this all together and assess these risks, and then will assign a premium to those risks. Now, in this insurance company, the other reason why it's called captive is it can only receive claims from you, only first-party claims. There's no way that some outside force or outside person could make a claim against your insurance company. You would have to be the one making the claim. Now, once they determine that these are the risks that are going to be insured, and then in addition to that, this is the amount of premium that would need to be paid for those risks, now your practice will pay that premium. That premium is paid from your practice as a business expense, again, to your captive insurance company. The captive insurance company can receive up to $1.2 million in premium without having it be considered income. Now, insurance companies then, as you probably are well aware, take money and then they invest. Now, these investments can be made with pre-tax dollars, similar to what you'd be doing in some of your other type of deductible investment plans, but with a major caveat that you have a lot more control over this money. You could have access to it now. You could have access to it at any point in time. And ultimately, once you ever decided that you wanted to withdraw money from your captive insurance company, as long as that money has been there from one calendar year to the next, it comes to you in the form of qualified dividends. Now, when we heard over this last election cycle of Mitt Romney with nearly $32 million in income and paid an effective tax rate of 15%, the reason why that was the case is nearly all of his income was coming to him as qualified dividends. Qualified dividends are treated like long-term, right now at least, they're treated like long-term capital gains.
Rob,
and
this example brings up a really good talking point for our audience, and that is that if dentists were traditionally, if they had been born into families that had a history of high income, it's very often that they would have been taught these strategies, or there would be advisors to the family that were providing these strategies, because these strategies have been in place for as long as there's been an income tax in the United States. Strategies like these have been in place. This captive insurance company, this is not a new 2013 strategy. If I'm not mistaken, that particular strategy goes back many, many, many years. Is that correct, Rob?
Yeah, 1917 is when these first were put in place, and they actually were instituted by the IRS as they were making some changes that would affect some major key players within the country, and so they were implemented by the IRS as a mechanism for them to be able to do this exact same thing.
And so almost 100 years. And so my point being that most dentists haven't had access to this information because they haven't had family situations where the education was part of the culture and part of the upbringing. And so I'm so excited that you're bringing this information to our audience, because they may be hearing this for the first time, but hopefully it is illustrating the kinds of things that can be done. And obviously in a one-hour webinar, we can't cover everything. I'm sure there are many, 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 many more details that we could cover, but I love the fact that you're opening up strategies that our listeners may not be familiar with in the past.
Yeah, thanks, Gary. Really my objective in pointing some of these things out is for them to see, wow, there are real things that I could do that would likely apply to me to minimize my tax. And there are hundreds of things that can be looked at. These are just a few examples of things. But it's a way to be able to be proactive and minimize tax. Now you can see with each of these strategies, there's things to be done on a regular basis. It's not the kind of thing that you can just at the end of the year when we're going to file our return and say, oh, what can I do to minimize tax? There's things that are done all along the way. They're simple. There's not a lot that needs to be done, but in doing those things and knowing what those are and then implementing those and having some help in implementing the right things that apply to you will help you to minimize tax. So I want to share an example, a little bit of a case study of a dentist that we started working with, and there's his situation in 2010. He built a scratch practice over a 4-year period of time. He had built up the practice to where he was at $1.2 million in collections. He had 48% profitability, was 52% overhead, and really he felt like that he got to the point where he wanted to be at. He had all his equipment paid for and felt like this year was going to be the year that would really get him where he wanted to be. Well, once
Rob,
we ran...
Let's our listeners feel a little bit of anxiety seeing that low overhead. I believe this particular example is a specialist, is an orthodontist. Is that correct?
It is. Yeah, this is an orthodontist. Yes. So when we did this, the planning for him of where he was going to be at based upon what his projections were going to be and where everything was going to end up, he actually was devastated. He wanted to pay off his house that year, and once he realized the amount of tax that he was going to owe, that wasn't going to be possible. And what he was really wanting or was expecting came to realize that it wasn't a reality. But over the next period of time, we spent some additional time with him, and this is not a quick fix type of thing, but we started to spend some time to be able to put together some strategy for him. And ultimately, the strategies that we put together, we spent a few hours and ended up saving this dentist in particular $122,000 in federal and state tax, and we spent about 5 hours together to be able to make this happen. I always like to ask the question, and I know that you can't respond being here on this webinar, but how many of you can make an extra $122,000 in 5 hours? I don't suspect there's anybody on here who can do that. But when you've already made this money, you already collected this money, it's already profit to your practice. If by putting in a little bit of extra effort and time, that return will be astronomical to you. By being proactive and having somebody work with you that's bringing these things to light and bringing these things to your knowledge and helping you to implement these things will make a dramatic difference in your financial situation. Now, also, I don't want to give the impression that in every situation, we can save somebody $122,000. This particular orthodontist went on the next year, increased their collections to $1.6 million, as well as increase their profitability. And the strategies that we implemented the following year actually helped him to save almost $160,000 over what he would have been otherwise. You can see how that can start to compound. As you work with somebody like Gary, that starts to put you in the situation where you're now having this income problem, or this tax problem, I guess, because of the increased income and the increased profitability. Especially, you need to have some good strategies in place to be able to protect that and minimize the amount of tax that you're paying. As we're getting here to the end, I guess, Curtis, we're going to come a little bit back to you, but having I just wanted to highlight that a little bit more. I'm really grateful for this opportunity to be able to be involved in this webinar with Gary, come to know Gary, and Gary is an incredible individual, provides tremendous value to the practices that he worked with. And thank you, Gary, for doing this together with us. I've enjoyed this interaction with you and getting to know better what it is that you're doing for practices. And Gary truly takes interest in the dentist and helps them to have a situation that's more desirable, where you're enjoying your practice as well as your practice is more profitable. So I would strongly encourage you to take an opportunity to get to know Gary if you don't already, and follow what he's doing. Key into some of the things that he's teaching. Maybe shoot a line to him, or send him an email and have him take a look at your practice and some of the things that he can do to be able to help you be more happy and satisfied with your practice. Not only from the financial aspect, but have it be a more enjoyable experience. I've seen those things happen with Gary and the practices that he works with. There's a practice that's not too far from me that I'm familiar with, that I know Gary works with, that's probably one of the most successful practices around. So I encourage you to take a look at Gary.
Well, thank you for those kind words, and I share the praise. The reason why I wanted to have you wanted to do this webinar and organize this webinar is that I've experienced the frustration of clients that work so hard to make their practice successful, and then it ends up having to just pay more tax, and in fact they just feel like it's so frustrating because they work so hard to make this happen. And you know, we all know that, we've all heard that saying that it's not what you make that counts, it's what you keep. And you know, dentists deserve to have financial independence. They deserve to be able to retire with dignity and with financial success. They've worked hard to do that. They've worked for many, many years to take care of their patients, and they deserve that. And the strategies that you know that you can teach clients are proven. They're in the white area of compliance, and I just couldn't be more excited about sharing this information. So, Rob, I felt like we're a really good team on this. I'd love to help a dentist improve their profitability to make more money, and then direct them to you so that you can help them develop the strategy so they can keep more of it. So we make a wonderful team on this, and I suspect we'll have some opportunity to do some more things together, and I'd really like that. I appreciate your firm, and I appreciate the professionalism of all of your team members, and I'd be thrilled to do further things together in the future. Curtis, why don't we turn it back to you to make some final comments?
Absolutely. I hope everyone that's joined us today has taken down some notes and followed some of these suggestions to implement into their office. This is great things that every dentist in the United States should know. I hope we can get this out to as many people as possible. Please feel free to share this with your friends, colleagues, and study groups. But if you want to contact Gary, his information is right there on your screen, Gary@TACUSLearningCenter.com, and put in the subject phone consult. If you want to get in contact with Rob, he does have a busy schedule, so go ahead and contact myself with my information down there. And I did twist both Gary and Rob's arm to give you a little bit more value added. Thank you. Thank you for being here on this webinar today. If you contact Gary or myself, whoever you do contact, we will make sure that you get a 30 to 60 minute consultation, free, that's absolutely free consultation on the services that they provide, whether that's a a thriving practice, or whether that's in tax and CFO consulting. These typically cost, and I believe, Gary, what do you typically charge for your consults?
Well, when we do those, we charge $497 for that consult, and we've agreed to waive that fee for any members that were here on the webinar as a courtesy for spending some time with us.
Thank you, Gary. And once again, sorry to twist your arm and have you do that for these attempts.
Happy to do so, Curtis.
Well, I'm glad. In addition, Rob also has a fee that he charges for these consults that we will be waiving that as well. In addition, as an added bonus, for all those that call it or email us today, we will send you a packet on how to dramatically reduce hygiene cancellation and no-shows. I know nobody has that issue, but if you do, please, we would be happy to send that as an added bonus. And Gary, can you give us a little bit more insight on what you expect with that program?
You bet, Rob. That came about as a result of so many emails that I received from dentists saying the biggest frustration they had was the rising increase in cancellation of shows and hygiene. So I put together about a 45-minute audio tutorial. It's audio, it's professionally recorded. It's 45 minutes of real practical information dentists can use to radically reduce cancellation, no-shows, and hygiene. We actually sell that as a digital product. It's a $97 digital product. However, we're providing that free of charge for an additive incentive for our listeners on this webinar.
Thanks, Gary. So that's nearly $1,000 worth of product that you guys can receive right away to better your practice, to get you on the right path to success, to, like Gary said, put you in a financial position which you deserve to be in. So thank you for being on tonight. We hope to have you on again on our next webinar series. And until then, we will talk to you soon. Thanks, Rob. Thank you, Gary.
Thank you, guys.
Thank you.